the simple moving average, SMA. So here we have a graph of the 10-day simple moving average represented by the blue line, and it measures the average mean in the prices of the securities. The simple moving average helps us smooth out the volatility in prices to help us identify trends. Now, to calculate the 10-day simple moving average, you take the closing prices of the previous 10 days and divide by 10 to get a point. And on the 11th day, we omit the price on the first day. We take the prices from day 2 to day 11, add them together, and again divide them by 10 to get a second point. And we continue with this process until we get many points, and we join up these points with a line, and we'll get a blue line, the 10-day simple moving average. Now, the simple moving average is a lagging indicator, which means it will follow behind prices. So for example, here we have prices starting to turn down right about here. But the simple moving average started to go down right about here. So the simple moving average moves behind the prices. We're going to show you additional steps on how we can reduce this lag. The simple moving average smooths prices and allows traders to spot trends. This is especially useful in volatile markets. Simple moving average is the average mean of a security's price over a specified period of time. Suppose we want to calculate a 3-day simple moving average. Also suppose that the closing prices for the previous days are 10, 15, and 11. So to calculate the first point, you add up 10, 15, and 11 and divide by 3 to get 12. Now suppose that the closing price for the next day is 16. We now recalculate using the newest closing value of 16 and omitting the oldest closing value of 10. So we take 15, 11, and 16, add them together, and divide by 3 to get 14. And we'll get a second point. We continue in this process. Lastly, we join a line through each point, creating the SMA. So we can use the simple moving average to give us entry and exit alerts. So here we have the blue line representing the 10-day simple moving average, and the green line, which is representing the 20-day simple moving average. So all you have to do is look for the averages to cross. So here we have the blue line crossing above the green line, giving us a buy signal. Here we have the blue line crossing underneath the green line, giving us a sell signal. Here again, the blue line crossed above the green line, giving us a buy signal. And here we have the blue line crossing underneath the green line, giving us a sell signal. So if we were to buy here and sell here, we would have caught this move going up. Here we got another buy signal, and here we have another sell signal. Now the moving averages work well during trending markets. Here we have a period of sideways movement. So here we have a trading range. And we're getting a false signal. So we got a signal to buy, and then all of a sudden we got a signal to sell. So this is giving us a whipsaw. Now also notice that prices started to move down right about here. But we got the sell signal here. So we have a late sell signal. And this is because the simple moving average is a lagging indicator, so it moves behind prices. Next, we're going to show you what is called the exponential moving average, which will help reduce this lag.